Types of business organizations. One of the first decisions that you will have to make as a business owner is how the business should be structured. All businesses must adopt some legal configuration that defines the rights and liabilities of participants in the business's ownership, control, personal liability, lifespan, and financial structure. This decision will have long-term implications, so you may want to consult with an accountant and attorney to help you select the form of ownership that is right for you. In making a choice, you will want to take into account the following: your vision regarding the size and nature of your business, the level of control you wish to have, the level of structure you are willing to deal with, the business's vulnerability to lawsuits, tax implications of the different organizational structures, expected profit or loss of the business, whether or not you need to reinvest earnings into the business, your need for access to cash out of the business for yourself. Now I will discuss overview of the 4 basic legal forms of organization: sole proprietorship, partnerships, corporations and limited liability companies. So first is sole proprietorship. The vast majority of small businesses start out as sole proprietorships. These firms are owned by one person, usually the individual who has day-to-day responsibility for running the business. Sole proprietorships own all the assets of the business and the profits generated by it. They also assume complete responsibility for any of its liabilities or debts. In the eyes of the law and the public, you are one and the same with the business. Now we need to know about the advantages of a sole proprietorship for exam point of view, so let's discuss it one by one. It is easiest and least expensive form of ownership to organize. Sole proprietors are in complete control, and within the parameters of the law, may make decisions as they see fit. Profits from the business flow through directly to the owner's personal tax return. The business is easy to dissolve, if desired. Now let's discuss about the disadvantages of a sole proprietorship. First disadvantage is this, that sole proprietors have unlimited liability and are legally responsible for all debts against the business. Their business and personal assets are at risk, may be at a disadvantage in raising funds, and are often limited to using funds from personal savings or consumer loans. May have a hard time attracting high-caliber employees, or those that are motivated by the opportunity to own a part of the business. Some employee benefits such as owner's medical insurance premiums are not directly deductible from business income, only partially as an adjustment to income. Now let's discuss about the partnership type of businesses. When 2 or more people come together to start a business is known as partnership. They share ownership of a single business. Like proprietorships, the law does not distinguish between the business and its owners. The partners should have a legal agreement that sets forth how decisions will be made, profits will be shared, disputes will be resolved, how future partners will be admitted to the partnership, how partners can be bought out, or what steps will be taken to dissolve the partnership when needed. Yes, it's hard to think about a breakup when the business is just getting started, but many partnerships split up at crisis times, and unless there is a defined process, there will be even greater problems. They also must decide upfront how much time and capital each will contribute, etc. Let's discuss about the advantages of partnership businesses. Partnerships are relatively easy to establish, however time should be invested in developing the partnership agreement. With more than one owner, the ability to raise funds may be increased. The profits from the business flow directly through to the partner's personal tax return. Prospective employees may be attracted to the business if given the incentive to become a partner. The business usually will benefit from partners who have complementary skills. Now we will also discuss about the disadvantages of partnership businesses. Partners are jointly and individually liable for the actions of the other partners. Profits must be shared with others. Since decisions are shared, disagreements can occur. Some employee benefits are not deductible from business income on tax returns. The partnership may have a limited life. It may end upon the withdrawal or death of a partner. So partnership businesses are divided into different types. So the first type is general partnership. Under this, partners divide responsibility for management and liability, as well as the shares of profit or loss according to their internal agreement. Equal shares are assumed unless there is a written agreement that states differently. Second type is limited partnership and partnership with limited liability. Here, limited means that most of the partners have limited liability to the extent of their investment, as well as limited input regarding management decision, which generally encourages investors for short-term projects or for investing in capital assets. This form of ownership is not often used for operating retail or service businesses. Forming a limited partnership is more complex and formal than that of a general partnership. Third is joint venture type of partnership business. It acts like a general partnership, but is clearly for a limited period of time or a single project. If the partners in a joint venture repeat the activity, they will be recognized as an ongoing partnership and will have to file as such and distribute accumulated partnership assets upon dissolution of the entity. Now the third type of organization is corporations. A corporation is chartered by the state in which it is headquartered, is considered by law to be a unique entity, separate and apart from those who own it. A corporation can be taxed, it can be sued, it can enter into contractual agreements. And the owners of a corporation are its shareholders. The shareholders elect a board of directors to oversee the major policies and decisions. The corporation has a life of its own and does not dissolve when ownership changes. Now we will discuss some advantages of a corporation. In corporation, shareholders have limited liability for the corporation's debts or judgments against the corporation. Generally, shareholders can only be held accountable for their investment in stock of the company. Note, however, that officers can be held personally liable for their actions, such as the failure to withhold and pay employment taxes. Corporations can raise additional funds through the sale of stock. A corporation may deduct the cost of benefits it provides to officers and employees. Can elect S corporation status if certain requirements are met. This election enables company to be taxed similar to a partnership. Disadvantages of a corporation. The process of incorporation requires more time and money than other forms of organization. Corporations are monitored by federal, state and some local agencies, and as a result may have more paperwork to comply with regulations. Incorporating may result in higher overall taxes. Dividends paid to shareholders are not deductible from business income, thus this income can be taxed twice. A tax election known as an S corporation allows earnings and profits to pass through to shareholders' personal tax returns. Shareholders working for the company must pay themselves a reasonable salary to avoid reclassification of earnings as wages. The IRS can impose payroll taxes on the total amount if reasonable compensation is not paid. Compliance is crucial, and professional advice is recommended. LLC, Limited Liability Company, is a hybrid business structure that combines limited liability features of a corporation with tax efficiencies and operational flexibility of a partnership. LLC formation is more complex and formal compared to a general partnership. Owners of an LLC are called members, and the duration of the LLC is typically determined during the filing of organization papers. The time limit of an LLC can be extended if desired through a vote of the members when it reaches expiration. LLCs are not allowed to possess more than 2 of the 4 characteristics that define corporations: limited liability to the extent of assets, continuity of life, centralization of management, and free transferability of ownership interests. Federal tax forms for LLC. Taxed as a partnership in most cases, corporation forms must be used if there are more than 2 of the 4 corporate characteristics, as described above. Thank you, everyone. Please don't forget to like and subscribe to our channel. I assure you that the remaining topics will be covered in upcoming videos on my channel, so press the bell icon so you won't miss our videos. Until now, goodbye and keep learning.